These gentlemen have battled, debated before, and we're going to leave time for your questions. So let's get right to it. Over here in this corner is Mike Larson. He's the editor of the Weiss Safe Money Report, as well as the Under the Radar Stocks. And over here in this corner is Market Timing Machine Mike Turner, president of Turner Capital Management. This is the battle of the mics, so let's get ready to rumble. All right. They queued up randomly. Mr. Larson's got a few slides first, so let's give him a few minutes to state his case.
All right, let me grab the clickers, so I have some slides to go through as well.
Thank you, Mike. Here you go, Mike.
All right, thank you, everybody. Since Tom mentioned football, I happen to be both a real-life New England Patriots fan and a fantasy football person who has the New England Patriots defense. So this week's gotten off to a very good start in both ways, and hopefully I'm going to dominate right from the beginning and have you convinced after I have my 5-minute intro. So with that said, I think before I defend buy and hold investing, I really need to define what I consider to be buy and hold investing, right? There's this assumption that it just means buy an S&P 500 index fund, hold it forever, don't worry about making adjustments and things like that. And I hope I don't offend anybody by saying it, but I think that's kind of a lazy and undisciplined approach to investing, right? There are, Weiss Ratings runs a ratings model against every stock, ETF, and mutual fund that trades in the U.S. or Canadian markets every single trading day. There are good stocks, there are mediocre stocks, and there are stocks that stink. And at different points in the economic cycle, different points in sort of, the expansions and contractions and so on, different investments work better. So you have to do what I consider, instead of buy and hold traditionally, it's buy and manage. Manage your positions. Look to profit from large mega trends, and don't get shaken out by every small wiggle here and there. And that's kind of my approach on that. So where do we stand now? How does that factor into sort of practical advice for this point in the cycle? All of my work has suggested that sort of the broad-based, powerful, fully participating bull market that we had starting in 2009 started to run out of gas in the first quarter of 2018. A lot of different things have happened since then, and I'm going to go through 6 slides quickly that show sort of what my view of that is, and I'll go into more detail in my presentations later today and tomorrow. First off, valuation, right? You have to have a valuation framework to be a buy and manage investor. Right now, as you can see from this slide, we're talking about an S&P CAPE ratio, cyclically adjusted price to earnings ratio, that's essentially double the long-term average or close to it, and the highest since the peak of the dot-com bubble. Second, if you look at the value of assets, so household net worth, the value of your stocks, your home, and so on, assets have never been so separated in terms of value relative to underlying GDP that we're seeing now. This chart just shows that we had the dot-com bubble peak, the housing bubble peak, and now this sort of tongue-in-cheek way of calling it the everything bubble because so many assets are swept up into it. So those are a couple of valuation things that have pointed to problems for this market. Again, cycles, economic cycles, interest rate cycles are important to follow. This is simply a chart of the yield curve going back to the late 1980s, 3-month bill versus 10-year Treasury yield. The spread has been falling for months and months and months. It inverted in March, has been mostly inverted since then. That tells you the economic cycle is probably coming to an end. Every single one of those white bars on the chart shows the start of past recessions, and you'll notice that they followed within a few months of the curve inverting to this degree. Credit markets, again, credit markets are very important. Are they confirming what's happening in equities or not? Since January of 2018, we have not seen credit risk hit new lows coincident with new S&P 500 highs. That's another sign of divergence and troublesome for this market. And recession odds, right? We've all talked about, is the economy heading into a recession or not? I believe yes next year. The New York Fed's own model has the highest recession chance that it would find going back basically since the last recession. And finally, like I said at the outset, you really have to let the economic cycle be your guide. You want to buy and manage. You want to own the right investments at the right point in the cycle, but don't get shaken out on every little thing. Don't try and time every move. Capture the mega trends, and right now that's defensive investing. So with that,
Mr. Turner.
I'd like to have the clicker, please.
Oh, please, just pass it over.
Thank you.
Give us your case.
Well, my whole approach is this. It's very simple. If the market's moving up in a bullish cycle, I want to be bullish. If it's moving down in a bearish cycle, I want to be bearish. The whole key, in my opinion, to making money in the stock market is to know where the market is. I just talked about guessing which cycle it is and all these things you can look at, and all those are important. I'm not trying to say that they're not. But at the end of the day, it's just too much guessing. It's guessing about whether you're at the end of the cycle, at the beginning of the cycle, what you're going to do based on what that's all about. So what I look at is I want to lower risk as much as possible. I definitely do not want to get trapped into losing a bunch of money in the next bear market. I want to be able to take advantage of that next bear market. I want to be able to take advantage of a bull market. And guess what? The stock market will tell you exactly when to do that. So I take a common sense approach. As I said, I only want to be bullish in bull markets. If I ask this audience whether or not we're in a bull market or not, some would say yes, some would say no. Most of you don't know. But the thing that's really, really neat about the stock market is that it will actually tell you exactly where it is, and I'm going to show you how it does that. If it's not in a bullish trend and it's not in a bearish trend, then get out of Dodge. You don't have to hold stocks all the time. There's no reason to have to do that. You're not a Warren Buffett. You're not a big asset management firm that can't go to cash. You have the ability to use cash to know when to be out of the market, and there's nothing wrong with being out of the market at the right time. So buy and hold makes three primary assumptions. Number one, you'll never need the money. Otherwise, you're not holding. Number two, you're going to live forever. Okay? Number three, you have no problem with losing 30, 50, 80% of your life's accumulated wealth from time to time. A lot of people invest in, not trying to knock Berkshire Hathaway or Warren Buffett, but he can't go to cash. He's too big. And he has said in recent times, Berkshire Hathaway is going to lose half of its value from time to time. Why go through that? You don't have to. Here's the fact. If the market drops 50% and your portfolio drops 50%, and if the market then recovers at 10% per year thereafter, it takes you 7.2 years to get back to even. Now, you could say, well, I at least got back to even. My money did come back. Your time never comes back. The time that you lost getting back to even, if you'd been able to put that money to work, growing instead of having to get back to even, you would have made a lot more money in the process. So ask yourself this question. How many 7.2 years do you have left? Buy and hold is the same thing as guess and hope. You buy something, you're going to hope it's at the right time, at the right part of the cycle, and on and on. I don't guess. You don't have to guess. I'm going to show you exactly what I'm talking about. So here's buy and hold compared to market directional investing from 2007 to 2018. Buy and hold got you 54% over that period of time. Just going to cash, and I don't have time to teach you how to do this. I will do this in some of my sessions today and tomorrow. But just going to cash, meaning getting completely out of the market and not taking a dime in interest. I'm taking the worst case scenario, just going to cash. You went from 54% to 124%. Now, how would you know to do that? That's the biggest question. When do I go to cash? How do I know when to do that? The market will tell you. That yellow band on there, which again, I don't have time to tell you, but I've written about it. You can read about it. You can do it yourself. It basically tells you when the market has moved from an uptrend to a neutral trend to a bear trend. And if it goes into a neutral trend, you just go to cash. So you would have more than doubled your money and not making a dime on your money by just going to cash. Now let's compare buy and hold to market directional investing from 1950 to 2018. Look at those numbers. Buy and hold got you 15,000%. That's not bad. But you could have almost doubled your money by going to cash at the right time. Again, no interest on the cash, not doing anything with it, not money markets, just nothing. I'm not saying you would do that. That's kind of dumb. There's a lot of things you can do with cash rather than be in the stock market, though. You can go into a safe, secure investment. If you went buy long and short, and when I go short, I go into inverse ETFs. It's a great way to do it. You almost quadrupled your money. Okay? So here's the summary. Buy and hold has a lower total return. It has much higher risk of loss. Why put yourself into a position that you could lose a third or half of your money by owning a really good stock? Great stocks. You've done all of your research. You're guessing that it's really going to do well in the future, but you could go down 50% in it. And it relies heavily on that kind of guessing. Market directional investing, that's just where you let the market tell you. Here's the thing. If the market's bearish, I don't look at any stock. I don't care how good it is. I don't need to. If the market's bearish, and you can mathematically measure that. If the market's bearish, then you should be in inverse ETFs. far higher total return, far lower risk of loss, no guessing, none whatsoever. Whenever you're listening to anybody up on this stage or any stage tell you about what they think is going to happen in the future, I want you to pay attention to two words that they might say. If they say, I think, they're guessing. Okay? I don't guess. You don't need to
We hear that
either.
a lot on TV these days, don't we?
We do hear a lot of that on TV. So, Mike and I, both Mikes agree that just pure buy and hold doesn't make sense. I go a little bit further and say, I don't buy and guess about anything. Okay? Market directional investing eliminates all guessing. It's far, far better return, lower risk, and no guessing. It's just math.
All right, since he just finished up and you've been accused of being a guesser, why don't you take a little shot at him and go after him and give us a little retort?
You know, you hear the term guessing, and it brings up images of, okay, I've got a pea in one of these hands, and, guess which one's holding it. And that's not what I'm waking up every day and doing in the newsletter and Weiss Ratings. Our model isn't just saying, I want to guess if this stock's an A or a B or a C or whatever. It's educated work. It's educated research. I don't consider it guessing. I consider looking at things that have worked in the past, evaluating, prudent evidence and data and so on, and then investing off of that. So
here's the big assumption.
I'm not saying that if the P's in this hand I'm bullish, or if the P's in that hand I'm bearish. I'm making educated judgments based on research. So that's the
here's the thing that Mike just said. I want you to pay really, really close attention to. Okay. That if you're just smart enough, and if you do just the right amount of research, and you do that educated, really well-informed guess, he would say choice, guess, you're still guessing.
All right,
It doesn't matter how much research you do. It doesn't matter how smart you are. Nobody in this room, not Mike, not me, not good old Jeff here,
I can
nobody
guess
is
pretty
smarter
well.
than the market.
So you went to a sort of defensive posture back in 2018. I mean, the market's a whole 2 to 3% below the highs, except for maybe the Russell 2000, was down about 13%. Granted, we haven't gone, I'll give you that, we haven't gone too far since 2018, but how is that not market timing?
Well, let's talk about what's happened. You brought it up, and thank you for giving me that soft pitch there. In the first quarter of 2018, based on all the things I talked about, and
Was it that soft?
It was a nice right over the plate. I like that. I basically said raise cash levels, get out of your offensive stuff, shift into defensives. This is sort of a late end cycle environment. I'm expecting recession to be down the road, so this is what you need to do, based on things like that cycle slide that I showed. Well, what's happened since then? Since January 18, the S&P's up maybe 1% or 2%. Defensive things like treasuries are up 25%, gold's up something like 30%. Safe money sectors, I call them, utilities, REITs, and so on, they're up 25% depending. And it shows that quote-unquote guesswork has really helped you trounce the market if you've made adjustments, managements. It's not, trading every single wiggle and so on. It's
Or just holding the Vanguard or the Spider.
This day and age, it's you've got low-cost ETFs and low-cost index funds, and it's so great, and every investor should be doing that and not caring what. No, that doesn't work.
So what's going to get you growthier again? That's what your little buzzword that you.
Sure. When do you go from defensives back to offensives? When you see the economy, the economic indicators start to turn, when you see interest rates start to turn. I mean, I am following.
So GDP.
GDP, retail sales, yield curve itself. The trend in employment growth and so on. All these
What
things.
about what Steve Moore said? I don't know if you heard. He said there's 7.1 million unfilled jobs, surplus jobs was his word. I thought that was pretty cool.
Well, what's interesting is the rate of job growth has been decelerating. I mean, you're at, right now, based on the last month's data, there's about 28% fewer jobs being created in the average month versus what we saw in 2018. So, we're not, in my opinion, we're not in recession yet, but a lot of things are pointing in that direction. And that's
deceleration.
deceleration, yeah.
So where are we at now in your cycle? Wrap it up.
Again, we're sort of in that very close to beginning of recession type environment. Defensives win. I think by the end of the first half of 2020, we'll probably be shrinking as an economy.
First half of 2020 recession.
The recession begins. That's kind of my base case.
We'll place a wager afterwards, just for gentlemanly. We're going to get to your questions in 1 second. I just want to ask Mr. Turner a couple things here.
Yes.
You talk a very good game there, Michael.
Thank you.
And it's impressive. Conviction is something. But give us a few examples. I know you don't have time to show everyone how all your indicators of cycles worse, but give us a couple examples of the great market timing, when you went to cash, when you went bearish, when you went bullish, some color so we know what you're talking about.
Absolutely. First of all, I think, Mike said that if you paid close attention to it. He thinks there's going to be a recession next year. He thinks there might be. Is that actionable? No. I don't think about whether there's going to be a recession or not. I wait and see what the market is not going to do, what the market is doing. The big difference between me and all these other guessers out there is that I wait until the market has moved. I don't guess what it's going to do. I wait until it has done it. And you think that that means that you've missed out on it. You're not. I can show you, and you can do this mathematically. You can let the market go to the top, roll over, and begin to go down. I don't get out at the very top. I wait till that top has gone by, and I can measure that. You can measure that. So this year, just
where
so...
are you at now?
Right now, I'm 95% cash. Why?
When did you go to cash?
I went to cash really about after the first quarter of this year. My models did this. The math showed this. When the market gets above what I call a transition zone. What is a transition zone? It's a 200-day moving average plus or minus one standard deviation of normal volatility. You're not going to hang on to all that. You can go look it up and see some of the videos that I've done, and you can see the detail. But basically, when the market gets above that, I'm bullish. When it moves down into that, which is where it is right now, it's approximately 10% inside that band. When it's inside that band, which is my go-to-cash band, stay out of the market band, then I'm 95% cash right now. I'm waiting for one more position I've got to be stopped out. I use stops on everything. I don't guess about anything. I assume that every trade I put on is going to go against me. That's why I have stops.
Where's the market got to go right now to get you bullish?
Who knows? The market's got to go, mathematically, for it to go bullish, it's got to go up about 1.5% from where it is right now. And
that's not a lot.
No, it's not. And break through the August 2018 high. When it breaks through that August 2018 high and stays there for more than 3 weeks, and it's all part of the rules I've got, then I'll be fully bullish in the market. If it drops right now from where it is, down about 5.5%, if it drops 5.5% from where it is right now, I will begin to be going bearish, going into inverse ETFs. It just depends on what the market's going to do. And
all right. We got Tom Sosnoff ran over a little bit on us, so we got to try to get to some questions out here. But you got one more thing to say, and then we'll get it out to everybody else.
Sure. One last point. Mathematically, the S&P has made a modest new high, 4 times since January 2018. Every single one of those has failed. Why haven't I gotten aggressive? Not because mathematically it went over and then went back down. It's because my research into other markets, credit, volatility, and so on, suggested that there wasn't as much participation. Our own Weiss Ratings model was showing there were less stocks that were rated buy relative to sell at each successive peak. So that kept us out, kept our guys out, and they didn't avoid chasing highs that failed. And I think that shows the benefit of not just having a mathematical rule, but doing research, doing that buy and manage approach.
All right. We have some questions from the audience I want to get to you guys. If you want to ask a question, put your hand up, and Rachel's going to come around with the microphone. And while you're doing that, I'll just tell you, full disclosure, I had a buy signal in my MACD seasonal timing system on Friday at the close. So we just went long on Friday's close, and that's one of our disciplines. Sir.
You both, I've heard this debate before, and I'm just curious because it seems like everybody's moved a little bit, and you're coming closer together. It would seem to me we'd like to put together some combination of the two strategies, and that might even be the best. What would you comment on that?
A combination of the two strategies might be good?
Yes. Yeah.
I wholeheartedly agree because that's one of the things we look at. We look at market timing, but I hold stocks until they stop going up. Let your winners ride, sell your losers short, and I use a bunch of different disciplines: seasonal, technical, fundamental, psychological, and monetary. Go ahead.
Here's what I do with that. First of all, I agree this much. If you're going to be bullish, you need to be looking fundamentally at what's available to you. So if the market says it's in a bull trend, and I only wait for that to happen, it's not right now. If it gets into a bull trend, then if I'm going to be into stocks, I look at both fundamentals and technicals, and I score each one of those. The fundamentals has 100 points, technicals have 100 points, and I score them and look at all that. But I do use fundamentals when I'm selecting stocks after, not before, after the market has gone bullish.
You do a little timing in your work, you'll have to admit, because you switch from different themes to
it's again
more economic cycle timing.
It's buy and manage. Like I said, it's not a if A plus B plus C happens, then do X. That's it's more of a holistic or whatever you want to call it approach.
Anybody else have a question out there?
Yeah, real quick, two questions for Mike Turner. The first one, what inverse ETFs would you go with? Maybe biotech or semiconductors that would have more of a bounce. The first question, though, most importantly, Peter Navarro's three-point break system. Could I use that on a weekly basis to track the market like you're talking about?
Which
Yeah,
ETFs do you use?
I think you're asking what inverse ETFs that I use. So let me go into if I'm in a 1X environment, then I do the 1X of the S&P 500, the NASDAQ, the Russell 2000, and the Dow. So for the S&P 500, for example, it's the SH. So just look at the 1X, the major indexes. That's the only inverses I get into because they're liquid enough and there's enough volume in them to be able to get out when you want to. If I'm in my 2X, which I've got a 2X version, which goes up twice as fast as the market does in a bull market, goes up twice as much as the market goes down in a bear market. In the bull market, I use SSO. In the bear market, I use SDS, Sam David Sam.
Any other questions out there?
Yeah, hi. So Ray Dalio just mentioned that central banks have lost their ability to stimulate the economy. So is that true if we start going towards recession and Fed starts doing QE and we go negative interest rates? Wouldn't that take care of the recession? Or central banks will fail?
I didn't quite hear that. Can you just ask the question quick, like shorten it up? What's the question?
Yeah, so I just want to know, have the central banks lost their ability to stimulate the economy or to overcome a recession?
Have the central banks lost their ability to support the economy
Yeah, to
That's
basically
what Ray
offset
Dalio
the
says, yeah.
and to stave off recession? Thank you.
Sure. My short answer would be monetary policy has gotten less and less effective over the last few years. We see it globally. We see, the ECB in Japan utterly failing to hit their inflation targets and stimulate growth with all the stuff they're doing. We only have, when we started this down cycle in rates, we had, much smaller margin to cut than we've had in any past cycle. And frankly, I think, what the yield curve's telling you is that the Fed's already too late. What's coming is already baked in. That's why the curve inverted. So yeah, I think the short answer would be the central banks can't do much at this stage. The fundamentals are taking over, especially when it comes to things like earnings and growth and so on.
Go ahead. You go, Mike.
So Mike said it again. He says, I think. Okay, now that means he's guessing. I don't guess and I don't care. About your question you asked, I don't care what the central banks are going to do. I don't care what the economy, now I care about the economy, I care about all those things as far as personally and what works out for the U.S. Consumer. But I don't care because with regard to the market, I wait and see how the market reacts to that news. If the market moves up, I'm with the market. If the market moves down, I'm with the market in an inverse way.
Thank you, Mike.
Again, it's all about what the market's doing, not what the individual elements are that's causing that to occur.
We have one other question over there.
This is for Mike Turner, a two-part question. First part is, when did your strategy actually go live? Not hypotheticals, but from live forward. And the second part is, what is the performance, positive or negative alpha relative to the S&P from the time it went live?
When did you go live and what's the performance?
I went live with this model in 2014. I have back-tested it to 1929. The back-testing has been a blind back-test, totally computer-generated, no human intervention. And so I've got that much time in grade. So I've not gone through a bear market yet in real trading, waiting for that to occur. I'm confident about what will happen. So everything I have done, I've back-tested for decades, if you will, but real live using this model since 2014.
And what's the numbers?
What's the number?
What's the performance versus the S&P, right?
Oh, it depends on the model. I've got three different models. I'm beating the model, the S&P in most of them. Last year I was up nearly 12%. The market was down 6.25. The year before I was up about 20. The year before that I was right at what the market was doing. The big difference between me and say the market is that, A, if we get into a bear market, I'm going to do much better because we're inverse ETFs. The other is that I don't try to just beat the market. You've got to deal with risk. There's a lot of risk in the market this year, for example. You could have just guessed and done really well. But I've been in cash most of this year because the risk is so high.
Thank you, Mike. We have another question over there? Behind you, I think. No. All right. Mike, you want to have one last comment?
No, I just think, again, you have to be prepared for what's coming in my, I'm saying my opinion. I'll say my opinion instead of I think. You have to be prepared for what's coming because research strongly suggests we're heading into recession. That means you have to have a whole different kind of investing strategy than you would have had from 2009 through 2018. So recognize and adapt as an investor.
Diversified portfolio with some market timing, some fundamentals, and a little bit of alts, I think is the best way to go. I think we got the exhibit hall opening up, so I want to thank everyone for coming and thank the Mikes for another fun debate. Appreciate it, gentlemen, and thanks, everybody.